Hello friends, myself Mitesh Save and my presentation topic is financial derivatives for the subject of derivative and risk management. What are derivatives? First, a derivative is a financial instrument whose value is derived from the value of another assets which is known as the underlying. Second, when the price of the underlying change, the value of the derivative also change. A derivative is not a product, it is a contract that derives its value from changes in the price of the underlying. Example, the value of a gold future contract is derived from the value of the underlying assets. For example, gold. Traders in derivative market. There are three type of traders in derivative market. First, hedger. A hedger is someone who faces risk associated with price movement of an asset and who use derivative as means of reducing risk. They provide economic balance to the market. Second, speculator, a trader who enters the futures market for pursuit of profits, accepting risks in the endeavor. They provide liquidity and depth to the market. Arbitrager, a person who simultaneously enters into transaction into or more market to take advantage of the discrepancies between price in these markets. Arbitrager involve making profits from relative mispricing. Arbitrageurs also help to make market liquid, ensures accurate and uniform pricing, and enhance price stability. They help in branding about price uncertainty and discovery. OTC and exchange traded derivatives. OTC, over the counter or off exchange trading, is to trade financial instruments such as stock, bonds, commodities, or derivatives directly between two parties without going through an exchange or other intermediary. The contract between the two parties are privately negotiated. The contract can be trail made to the two parties liking over the counter market are uncontrolled, unregulated, and have very few laws. It more like a free fall. Exchange traded derivatives. Exchange traded derivative contract are those derivative instruments that are traded via specialized derivative exchange or other exchange. A derivative exchange is a market where individual trade standardized contracts that have been defined by the exchange. The world's largest derivative exchange by number of transactions are the core exchange. There is a very visible and transparent market price of the derivative. Economic benefits of derivatives: reduce the risk, enhance liquidity of the underlying asset, lower transaction cost, enhance liquidity of the underlying asset, enhance the price discovery process, portfolio management, provides signals of market movement, facilities financial market integration. What are futures? A future is a standardized forward contract. It is traded on an organized exchange. Standardization, quality of underlying non-required financial features, delivery dates and procedure, price quota, type of future contracts, stock future trading, dealing with shares, commodity futures trading, dealing with gold futures, crude oil future, index futures trading, dealing with stock market indices, closing of future position. Most futures contracts are not held till expiry but close before that. If held till expiry, they are generally settled by delivery to 3%. By closing a future contract before expiry, the next difference is settled between trades without physical delivery of the underlying. Terminology: contract size, the amount of the asset that has to be delivered under one contract. All futures are sold in multiple of lots, which is decided by the exchange board. For example, if the lot size of Tata Steel is 500 shares, then one futures contract is necessarily 500 shares. Contract cycle: the period for which a contract trades. The futures on the NSE have 1 month, 2 month, 3 months expiry cycle. Expiry date: usually last Thursday of every month or previous day if Thursday is public holiday. Terminology: strike price, the agreed price of the deal is called the strike price. Cost of carry, difference between strike price and current price. Margins: a margin is the amount of money that must be deposited within the clearing house by both buyers and sellers in a margin account in order to open a future contract. It ensures performance of the terms of the contract. Its aim is to minimize the risk of default by entire counterparty. Marketing to market. This is the practice of periodically adjusting the margin account by adding or subtracting funds based on changes in market value to reflect the investor gain or loss. Second, this leads to changes in margin amounts daily. This ensures that there are zero default by the parties. What are options? Contracts that give the holder the option to buy, sell specific quantity of the underlying assets at a particular price on a before a specific time period. The word option means that the holder has the right but not the obligation to buy, sell underlying asset. Type of options. Options are of two type: call and put. Call options give the buyer the right but not the obligation to buy a given quantity of the underlying assets at a given price on or before a particular date by paying a premium. Puts give the buyer the right to buy the right but not obligation to sell the given quantity of the underlying assets at a given price on or before a particular date by paying a premium. Type of options. The other two types are European style option and American style option. European style option can be exercised only on the maturity date of the option, also known as the expiry date. American style options can be exercised at any time before and on the expiry date. Future of options: a fixed maturity date on which they exercise. Expiry date: the price at which the option is exercised is called the exercise price or strike price. The person who writes the option and in is the seller is referred as the option writer, and who holds the option and is the buyer is called option holder. The premium is the price paid for the option by the buyer to the seller. A clearinghouse is interposed between the writers and the buyer which guarantee performed by the contract. Option terminology: underline specific security or asset. Option premium: price paid. Strike price: pre-decided price. Expiration date: date on which option expiry. Exercise date: option is exercised. Open interest: total number of option contracts that have not yet been expired. Option holder: one who buys option. Option writers: one who sell option. Thank you.